Welcome back to the Trading Coach Podcast. As always, I'm your host, AKIL'S. Thank you so much for the massive amount of support you guys have been giving me, not just since we've started this podcast back in 2018, which is crazy, but the more and more kind words that are coming in. It's pretty cool to be doing this for so long and still have that fresh new podcast feel to it. In today's episode, I want to share with you a recent presentation that I did to a small group of traders talking about risk management and kind of looking at the different elements that, well, as traders, you need to pay attention to. Now, this is a visual presentation, so if you want to watch and follow along, make sure you check this out on Spotify and YouTube, or you can just listen and you should get the same amount of education from it. All right, let's hop in. Risk management is the process of identifying, evaluating, controlling your losses in a trade or an investment. So we'll focus on a few areas of this and in a few different ways, but one is going to be determining your risk appetite. And before we get into it, because I know you guys are going to ask the question, when it comes to risk appetite, a lot of this is it's up to you. Everyone is different. Everyone has a different risk appetite. We can advise kind of the ranges on what you should risk, but ultimately everyone's different. Like, some people will be like, man, Akil, I would never risk this. Other people are like, I'm comfortable risking this. And so it's understand that everything we do in trading is fluid. And that goes for even when we teach you like the technicals and strategies. We always advise that, hey, we can teach you a strategy, but you want to make it your own because your lifestyle is different. Your availability is different. So just keep that in mind as a theme as we go through this workshop. But position sizing is part of determining your risk appetite. You know, what size of a position are you going to trade? Your stop loss. Right? Where is your stop loss going to be? How far? That goes into your position sizing and your total risk too. Another one is determining your risk reward ratio. Right? Your risk reward ratio is pretty much a ratio of what you expect to gain from a trade if you're right versus what you're willing to lose from a trade if you're wrong. This is also used by many to kind of calculate your expected returns. If you know there's something called profit factor, there's something called expectancy, where pretty much if you know your win percentage and if you know your average risk reward, you can pretty much tell yourself how much you're likely to make during the year or at the end of the year or month or whatever you're calculating it for. So that's going to be important as well. And then determining your active exit strategy, right? Active trade management, right? This is the strategy of kind of what adjustments that you make as the trade plays out. And there's a positive and negative to this, right? There's active trade management that can massively help your trading results. And then there's an active trade sabotage, I would call it. I don't know if I want to call it management, but active trade sabotage, where you can kill your account by doing dumb things. But that's all a part of risk management. Now, some of the common risk management mistakes that we see. Trading too large of a position size, right? Have you guys ever heard the stories of people making like 50% a year and all that fun stuff? I got a cool chart to show you on that later. Or 50% like a month or something like that. These crazy returns. Well, they're not all lies. They're not all lies. Some of it is just curve fitting, which is like bending the truth, right? So let's say I get on a hot streak, I hit 5 trades in a row, and I do so with a massive position size, but I happen to win. I could have easily made 50%. Now, these traders don't stand the test of time because eventually you're going to lose, and when you lose, if you're trading that big of a position size, you're going to blow everything. But technically, for that whatever 1 week period, they made 50%, so it's not a lie. But a lot of traders trade too large because the larger you trade, the more profit you'll make. And that's how many of us come into the market. Again, good traders are great risk managers. That's a quote from a professional trader. Most people don't come in with a professional mindset. They come in like I did, where it's like, how can I make as much money as possible as quickly as possible? Ooh, ramp up this position size. That'll do it. Because we take a look at the earnings, but never the losses. Another common mistake is not using or choosing a poor stop loss. So not using a stop, use protection. Ms. Singletary told us that. Or choosing a poor stop loss, right? And there's many reasons that this happened, fear and greed, but one of it is fear of getting stop hunted or just being undereducated, like not knowing where a correct place to put stops in, right? We spoke about psychological numbers earlier. Many of you guys didn't know what a psychological number was. So you could be in a trade where you put it right at a psychological number, which is an incorrect place, in my opinion, to put a stop loss. And you lost money just because you didn't know. So that's part of it as well. Another one is a poor understanding of risk-reward ratio. And this is using random risk-reward ratios. Now, again, this is something that is doable. I don't poo-poo any strategy, but I'm not a personal fan of it. So an example of this would be like when I say, hey, I'm just going to choose a 2-to-1. And I'm like, why? Because it sounds good, right? That is random. We never want to introduce randomness into our trading, and I'll talk about that a little bit more later. And then the last one, again, is the active trade management. Sabotage. Active trade sabotage. Taking profits too early. Moving stops back. Adding to your position. Revenge trading. Is there anything else that you guys have done that's not on this list? Any other type of sabotage you've done? Early profits. Moving stops. Position adding. You're in a state of euphoria because it's going in your direction. You're like, I want to make more. Let me add to that position. You're really just adding risk. Bianca says, placing myself in a hedged position. Stop loss is too big of a stop loss. Late entry. That's a good one. Yeah, entering late. Yeah. That's another emotional thing. I missed it. FOMO, right? FOMO, entering too early because you don't want to miss out. Entering too late because you don't want to miss out. That's a good one too. Yeah. That's good. Those are good ones. You guys are just as bad as I would know. Those are good ones. So let's talk about the first one, right? Let's talk about too large of a position size, right? How much should I risk per trade? I want you to type it in. What are you comfortable risking per trade? Or what do you think is the upper edge of how much you would risk? What is the upper edge? And be real. 50%, Wilson. Well, that's how you made that $2 million. Wilson. Now I'm picturing Castaway and the ball, and yeah, it's a whole thing. Right? So again, risk appetite is up to the individual trader. I don't tell people how to use their money. So I don't tell people what to spend their money on, right? Some people buy video games, right? Some people buy fancy clothes, right? I'll give you myself, for example. I don't buy anything like fashion, right? I'm comfortable in a nice pair of sweatpants and some shoes that don't hurt my feet. I spend money on sporting events. I tend to spend money on microphones and cameras, right? So however you want to spend your money is up to you. I don't judge how people spend their money. So whatever you want to risk is up to you, right? As long as you know the consequences of it. I would say this. Typically, what you see most professional traders risk is between 1% and 3%. So like 3% would be that max. We're like super risky. So you see that in the yellow. Left-hand side of your screen, anywhere between 1 and 3, or I guess -1 to 3 would be the typical range. Once you get above 3, a little dangerous, but hey, if you know your system, you know your strategy, you know what it produces, it's manageable. Once you get above 4, like 5%, I think you're playing a dangerous game. And the reason for that is this. I shared this in the last workshop, and I just thought of this morning. I was going to talk about it. I'm like, wait, I have a chart somewhere. So I tried last second to kind of get it into the display. But I want you guys to take a look at the difference between risking 1% and risking 5%. When things are going good, right? Because things will never go bad as a trader. They will only go good, right? Wilson told us that. Wilson, right? Real quick before we get into this. Do you have varied risk on trades depending on how confident you are? No. And here's the thing. So I would be lying if I ever said I was confident or not confident in a trade. So just getting the human being side of it, right? So we're going to separate the human from the trader. And I think Jason will agree 100% with this, right? Sometimes we have trades, we have go-to trades. We have grade A trades, we have setups where, we'll talk to each other and I'll be like, Jason, man, pound New Zealand for Dubai. He's like, oh baby, yeah, like it looks ready. It looks ready, and we feel confident. We have other trades that we take where we don't want to take it. We have plenty of trades that we take it and we're like, I don't really want to be long euro dollar, but the strategy says you got to do it, and you got to do it, right? So we have trades where you're unconfident. You have trades where you're very confident. It's weird. It's probably a psychological thing. It definitely is a psychological thing, but I feel like the more unconfident I am in a trade, those usually win. The ones where I'm super confident, they always lose. Or like the curse of YouTube. Whenever you do like a good trading video on YouTube, it always loses. But like the 10 others that you did during the week all win. Like it's the curse of, and then the trolls come out, you never win. You're like, well, you didn't see the 10 others. Yeah, whatever. But yes, there is confidence and unconfidence in the trade, but that doesn't matter. Because we are trading a system and a strategy that has a proven edge. And just like the coin flip video that you guys are all going to invest an hour in later, our job isn't to pick and choose winners or losers. Because we never know. Like, I couldn't tell you whether a trade is going to win or not. It could be a grade A trade, the best setup in the world, and it may lose. It could be a horrible trade, but it wins. Like, we never know. But our job is, I know that if I trade this particular setup in this pattern consistently over weeks, months, years, I'm going to make money at the end of the day, right? So it's funny because I tell traders this, like I don't know what my day-to-day results are going to be, my week-to-week results are going to be, even my month-to-month results. But I'm pretty accurate at telling you what my year results or the range that my yearly results are going to be in. It's the law of large numbers where everything kind of settles out. Right. With that being said, there are strategies where you can do that. So we have something called the CTS system, a combined technical score strategy, where basically you quantify your trade setup. So you have like you do analysis, you provide a score based on different kind of technical factors that you see, and the more you have, the higher your score is. And part of the CTS is like, hey, let's say the CTS ranges from, I guess, 0 to 15. Right, I think it's 13, but let's say you added some stuff just to make it easy. You can tell yourself, hey, if I have a score of 10 to 15, I'm risking 3%. Because theoretically, this should have my numbers have shown me that when I have a score this large, it's more likely to win versus lose. So I'm comfortable risking at the upper end of my risk on the trades that I should be winning more. If I have between 5 and 10, maybe I trade half a position. I risk 1.5 because these are like, this is a good trade, but like not as good as the other one. And then maybe if I have between 3 and 5, maybe I still want exposure, but I'm going to risk a half a position. Because these trades, they're still good. They have a positive expectancy, but certainly not as likely to win as the upper one. So I risk less. Does that make sense? That scale, you risk more on a trade. And so it's confidence, but it's not like human confidence. It's numbers. It's number confidence, right? It's qualitative confidence, because your numbers have told you that this type of trade wins at a higher level versus that type of trade. No one's typing. I think I lost you guys. Does that make sense? I hope we didn't dig too much into it. Let me know if that makes sense to that question. It's a really good question. Okay. Yeah, I know you're here. It's always hard doing the internet thing. Like when you're on a stage and you're talking to people and you can see their facial expressions in their eyes and you can tell like if they're engaged or not, or if they zoned out and you lost them. Here on the internet, like we don't know unless you type or don't type. So whenever we see you don't type, we're like, oh no, we went too far. So yes, that is certainly something that's doable. I lost where that question was at, but yeah, everything could be connected. And the cool thing is, when you learn about back testing and the numbers and building a strategy, you have all the data in front of you to make all the best decisions. So you're never guessing. Like Jason looks at his back testing results and says, hey, this type of trade wins this percentage of the time. And the frequency is this. So I know that I can do X, Y, Z on this versus that type of trade. I have to do this. And it takes the emotions out of it. It's just numbers. It's business. It's business. My wife was asking me the other day about Amazon kind of factories. I'm like, well, how do they know what people want? So how do they know how much to store? I'm like, well, they have all of our data. They know everyone in this specific area and what they buy, how much they buy, and they know how to stock their factory stores accordingly. If they know something is popular, they know how many people are buying it and they get more of it. If they know something is less popular, they get rid of it. Just like any type of business. If McDonald's started selling hot dogs and no one's buying hot dogs, they're not selling hot dogs anymore. So it's just like that. But anyway, 1% versus 5% risk. So look at this in front of you. This is based off a 17 trade winning streak. I've never had a 17 trade winning streak. I have had a 17 trade losing streak, which is why I chose that number. But this is what it would look like. If I risked 1% and I won 17 trades in a row, I would make a whopping 18.43%, right? I think that's amazing. Some of you guys are probably like, yeah, but based off 17 trades in a row, shouldn't it be more? Just like that client I had. If you risked 5%, oh, here we go. This is going to get your juices flowing. If you risk 5% per trade and you win 17 in a row, you just made 129% return. Who likes that? Give me a yes if you like that. You like that? Yeah, you like that. Don't lie. I like it. Where's my, I'm going to type in yes here. Let you get, hell yeah, I like that. Yeah. Yeah, I like that. Yeah. Now, that's the side that we look at when we're blinded and we think we're going to be super traders, when we're thinking about profit and not the other side. The other side, if you have children watching, close their eyes. It gets a little not safe for work around here. The other side is this. So let's look at it from a losing perspective. Because again, I have had a 17 trade losing streak. Wasn't enjoyable. Fortunately, I had a friend who beat me. He was at 18. And it's good to have that community because I'm pretty sure I would have quit trading. But when you have someone that's going through that struggle with you and you can joke around about it, the tears are a little bit less acidic. But if I'm risking 1%, that's a true story. His name was Lax. I love Lax to death. He's the one that gave me a good quote. He said, trading is a journey of self-discovery, meaning that you learn a lot about yourself as a trader. And boy, over the last, 18 years, I've learned a lot about myself. It's amazing how what you learn in trading relates to your outside life. I say outside life like trading, like we're inside a pod. Your non-trading life. But I lost 17 straight. Not fun. Now, if I'm risking 1% and lost 17% or 17 straight, I only lost 15.7%. Now, I know 15% loss isn't great, but given the fact that you lost 17 trades in a row, you would take that, right? I did take it, but I would take it. If you tell me I lost 17 trades in a row and somehow didn't quit and I only lost 15%, I'll take that. Now let's go back to the 5% where you were all excited about that 130% return. If you're risking 5% and you lost that same 17 trades straight, you almost lost 60% of your account. That's crazy. But the even crazier thing is this. This is your maximum drawdown recovery chart, which pretty much tells you on the left, if you lose that much, shift to the right, that's how much you have to make to get back to break even. So if you lose 5%, you've got to make 5.3% to get back to break even. Not bad, right? You lose 10%, you got to make 11% to get back to break even. Not bad. I don't even have 60% on here. But if you lose 50% of your account, you have to make 100% to get back to break even. You're done. That is like being stuck in credit card debt where the interest rate charge on your credit card is more than what you can actually pay off. So when you pay your whatever monthly, it only covers the interest rate that they charge you, but doesn't actually cover the amount that you spent on that credit card. And then you still spend the same amount on that credit card next month and get an even bigger interest rate charge, right? It's stupid, right? So you're paying whatever a month on your credit card, but you're not actually making any ground up. Like, you're pretty much done. This is why risk management is so important. You can dig yourself out of these holes, 5%. You can dig yourself out of 10%. You can dig yourself out of 15%. I don't know how you can dig yourself out of 50% without investing more money. Why would you even risk it to put yourself in a position where you could be done? Why? Why? Good traders are great risk managers. Every trader loses. The best traders are good at managing those risks so that they can survive their losses, wait them out until that next stretch of wins come. It's when I saw this chart for the first time, Stephen Burns shared it with me. Blew my mind. Blew my mind. I never thought about it like this. I never visualized it. I've never been down 50%. Well, maybe early on in my career when I was Dak, the demo count king. But after that, yeah, and it's like it's ridiculous. So be smart about that position size, right? Maybe this gives you kind of more reason to kind of stay here in the left side where you can take a lot of losses and still be manageable versus on the right side where skull and crossbones. Hope you enjoyed the presentations. We do a few of these each year. I think the next one's going to be in March. So make sure you pay attention to the space. Make sure you're in the loop. Make sure you frequent the Trading Coach podcast and the YouTube videos. That way you don't miss when the links and the dates come out. We do put a ceiling on how many people can be included. So trust me when I say you'll want to sign up quick. All right. See you guys next time. Take care.